what exactly and how does PMI insurance work?
Depends on the program. So depends on the program, and it depends on the down payment. FHA programs, they're run by the Federal Housing Administration. It's set PMI. So the Federal Housing Administration says on every loan you have to pay 1.75% of your mortgage amount. It gets wrapped in. Your mortgage actually increases. You pay it over the 30 years. And then you have a monthly amount. Depending on your down payment, that monthly amount is either going to be on there for the life of your loan. So if you put down less than 10%, you're going to pay that for the life of your loan. It's calculated off your mortgage balance, so it lowers as you pay the mortgage down over time. If you put down 10% or more, it comes off after 11 years. So you pay for 132 months. Same principle, it lowers as you pay the balance down. Conventional mortgage insurance is provided by private companies. So, there's private mortgage insurance companies that insure our loans when a borrower makes less than a 20% down payment. And that mortgage insurance is going to be determined by your down payment percentage, your FICO score, your debt to income ratio, and you're required to pay that mortgage insurance until you get the value down to, technically it's 78%. At 78%, it automatically comes off. At 80%, you could send in a letter to your servicer and have it removed. New York State's very easy for getting the mortgage insurance removed. So as long as you send it in, once you get that balance down to 80%, it comes off.
Okay. I have another question going back to PMI. If you're doing a conventional loan and you have PMI, can you pay the PMI upfront?
Yeah, so there's different options that are offered by the private mortgage insurance companies. The most common is a monthly payment. So it's a percentage of your loan amount, again, based on that down payment, income, and credit. Mortgage insurance companies will also give you an option to buy out that mortgage insurance at closing. Depending on the down payment, if you're putting down 5%, 10%, you typically get a discount from the mortgage insurance companies to do that. You pay less over time. But it all goes into the planning, right? How long do you plan on being in the property? Do you plan on prepaying the mortgage? I have clients, right now we talk about obstacles for buying. One of the biggest obstacles is selling a home, right? If you have a buyer, if somebody wants to buy a new home, but they have to sell their home, or they want to sell their home for the down payment on the new house, that's a big concern. So what we look at with these buyers is, hey, can we put a plan in place where we don't have to sell your home to buy this new one? And a lot of times that involves putting down less money, having mortgage insurance, but then we're going to make a lump sum when the current home eventually sells, right? So in that case, you wouldn't buy out your mortgage insurance because you're only going to pay a couple of payments.
Right, you're only going to be doing it for maybe 1 month or two.
Right. So it all comes down to the planning, but there are options to buy it out to lower your monthly payment. If you have the ability and you have the money in the bank to set up that option, you're typically going to save money. It's going to save you more monthly than just taking that money and putting more down on the